Ukraine has just surprised Russia by launching a ground incursion into the Belgorod region, the first land incursion or invasion, should I call it, of Russia since World War II. What does this mean for the economy? What does this mean for the war? Steve Hanke is back. He is a professor of applied economics at Johns Hopkins University. We'll be addressing this topic as well as Federal Reserve monetary policy, what the Treasury is doing. It's been speculated they're manipulating interest rates, which really is the purview of the Federal Reserve, but we'll talk about that. And we'll address some viewer questions. A lot of you posted questions on my channel under community, so thank you for that. I'll read as many questions as I can. Professor Hanke, thank you for returning. Welcome back.
Good to be with you, David.
First question that was asked by somebody by the name of Matthew Thurn is, how is Mr. Hanke?
Mr. Hanke's just fine.
Okay, good. We're
As they say, David, alive and kicking.
we're good that you're well. It's good that you're doing fine, and we appreciate you coming back regularly
Well,
and answering our questions.
well, I appreciate the question. I mean, nothing's more important than how you are, and I'm doing pretty well.
All right, good. Well, if you have any questions for Mr. Hanke, don't forget to write to him. I'll put the email in the description, and also you can write to me as well. Anyway, let's get on to today's news. Over the weekend, Ukraine invaded Russia. Let me share with you the story here from the Financial Times released this morning on Monday. Ukraine's incursion displaces more than 133,000 people in Russia. Russia rather, said it evacuated more than 133,000 people from border areas on Monday as Ukraine pressed on with a surprise incursion, which Kiev claimed that has now taken over 1,000 square kilometers of territory. Ukraine's offensive, the first ground invasion of Russia since the Second World War, has caught out Moscow's forces since it began a week ago. Now, this is Putin's response. An assessment of the ongoing events must be certainly made, and it will be, Putin told his security cabinet and the governors of 3 Russian border regions. But the main thing now is solving the task at hand. He said that there was going to be an appropriate response to Ukraine's incursion into the Kursk region, and claimed his forces had stepped up their advance elsewhere along the front lines. He said Moscow would not participate in any potential peace talks with Kiev. The ruble fell to its lowest level since May, just today, over the weekend. Before we go any further, what's your first reaction to the story, Professor?
Well, there are kind of several reactions. One, I think uh, Ukraine is, from a military point of view, in big trouble. There's no question about that. So I view this as kind of a Hail Mary pass. Now, the thing that's interesting is that they made the Hail Mary pass, and the thing was caught. It was successful. It surprised the Russians. So the Russians were caught with their pants down, which is really quite surprising to me, because this area, this region, they have been lobbing occasional missiles and so forth over that border. So why the Russians were asleep at the wheel is beyond me. But the third thing is the fact that there will be a counterattack, and my view is that the Ukrainians will really be put in the Russian meat grinder. So there'll be a fierce counterattack, and the whole thing will end up going for naught, because the Russians will get rid of them and push on. As far as the Russian economy, you mentioned the ruble. It did go down about almost 3% overnight. It's a move, but not that big of a move as exchange markets go, foreign exchange markets go. But the interesting thing to me is that the Economist magazine is an article, and I'm paraphrasing a little bit. I can't remember exactly what they said, but the thrust of it was that the economy in Russia is doing extremely well, as they put it, surprisingly well, with all these sanctions and so forth. That doesn't surprise me. The economy is doing well in Russia, number one. And number two, the blowback effect on Europe of all these sanctions that have been put on Russia has been devastating. Europe is doing very badly, and part of the reason they're doing so badly is because of the sanctions blowback. They're not getting oil, gas, natural resources, and so forth. Trade's been all disrupted with Russia, and that's been a very costly exercise for Europe. So that's in summary what my take is.
Before we continue the discussion, I want to take a minute to talk to you about today's sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of U.S. companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. I like to get your take on U.S. response and what this may mean for foreign policy. First of all, this has been going on for a couple of days now. So Ukraine, powered by Western arms, stuns Russia in cross-border assault. This is from the Washington Post, dated August 8th. Ukrainian troops battle for a Thursday in Russia's Kursk region. U.S., Ukrainian, and Russian officials all acknowledge the ongoing attack, which stunned Moscow. Importantly, it says that the Ukrainians are using U.S. and Western weapons, and the Biden administration has not given any objections to this incursion, this surprise attack into Russian soil or on Russian territory. Professor Hanke, I mean, do you think this was sanctioned by the U.S.? It doesn't say explicitly.
Well, this attack might have surprised the Russians. It didn't surprise the U.S. and NATO because it's rather obvious they had their hand in the whole thing. And so the Ukrainians could have never pulled this off without NATO and U.S. support and a U.S. green light. I mean, you have to put this thing in the larger context. The war in Ukraine between Ukraine and Russia is a proxy war. It's the U.S. versus Russia.
Yes,
you have to figure out who's fighting who, and basically it's the U.S. against Russia.
Well, has the current administration changed its attitudes towards the war? Because look at this paragraph here: a development that drew no immediate objection from the Biden administration, despite its past restrictions on use of American weaponry. So, at the beginning of the outbreak of the war, the American administration objected to the use of U.S. weapons to strike into Russia. Then that changed earlier this year when they gave them missiles.
No, it's much more nuanced than that. They didn't object to lobbying these attacks in this particular region.
Yes,
they had objected or had restrictions on different kinds of attacks going from Ukraine to Russia. There were certain things that were off limits, but this particular area is. They as I say, they've been lobbying things in there for a long time, mm-hmm. And that's why the Russians were asleep at the wheel on this. I don't know. It clearly surprised them.
Okay, well, I thought there was an open line of communication between the West and Russia, even now. I guess not.
Well, there is but. Do you think the U.S. would the commanders in NATO would call Moscow saying, "Oh, by the way, we're going to have a surprise attack
I
and send
well,
1,000 troops into that area."
yeah, I
No,
thought the whole idea was to not escalate before the election. And by the way, how is this going to impact the election, if anything?
I we'll have to see how it evolves.
Yeah.
I really have no idea,
Okay.
and it depends on what happens. I think the next step will be the meat grinder, and the Russians will crush them. That,
Well,
that's that's what's going to happen. I mean, and that's why I think the Hail Mary pass, although it was successfully completed, it surprised the Russians. It's a big diversion from the fact that Ukraine is getting trounced in the war. That the headline changes now. The headline looks like, oh, they got some firepower, and it's a positive spin now for the Ukrainians. But the reality is they've been getting crushed. And
it says here,
so I think this is a short term little blip on the radar screen, and so we'll have to see how the counterattack develops, and
yeah,
what aspects of the meat grinder are going to be turned on.
I mean, this is pretty significant. To my knowledge, this is has the have the Russians been invaded on their home soil since World War II by
No,
another
no,
nation?
no, they haven't. So it's very symbolic. I'm not saying it's a trivial thing, but I think the West and the Ukrainians better prepare for a pretty good counterattack. And remember, by the way, that was always, if you mentioned World War II. If you go back to World War II and you read, for example, the autobiography of Field Marshal Montgomery, the big thing he was always worried about was the Germans' counterattacks, because the Germans' counterattacks were more deadly than the attacks. So counterattacks are potentially lethal, and I think there will be a counterattack. Whether it will be lethal and significant, I don't know. But
I don't
there
what do you I don't know if the Ukrainians are planning to occupy these territories or just pull back after this attack.
I have no idea, but they won't be there for very long. Believe me.
I mean, if you brought up history, I don't think any invasion of Russia in past wars have resulted in a successful occupation for very long. So,
Well, it's yeah. We can even go back to Napoleon,
well, yeah, that's what I was, Napoleon, World War
as
II, yeah.
as well as the Germans. So it's as I say,
Well,
it's a diversion. It changes the spin on what's going on temporarily, but I think in the long run, I don't think it was a wise thing to do, is
well,
throwing the Hail Mary.
it certainly makes, I guess, just from a headlines perspective, the Biden administration look good because now they're making advances into Russia. This is 2 months, 3 months before the election.
Oh,
Maybe this was,
I,
yeah,
I agree.
right. And do you think that? So, can we also just make the assumption that perhaps the Ukrainians are discounting a Trump victory because Trump has made promises to mediate peace talks or at least negotiate some sort of deal? But
Well,
if Trump is
I
not going to be president, the Ukrainians are going to forgo that altogether and just do what they're doing now, right?
well, it's really hard to make much of an intelligent comment about this sort of thing, because to do so, you really have to be an insider. I mean, we can speculate and come up with conjectures about this, that, and the other thing, but now we're getting out into the weeds, and the only way you can say things with authority when you're in the weeds is to be an insider. And I'm not an insider. I don't know.
Look, a couple of weeks ago, it was reported that there was interest from at least the Ukrainians to have peace talks with Moscow. Are they going to abandon this strategy altogether? The Washington Post article is saying that they're probably perhaps using this as tactic
Well,
leverage, but
it depends on who you're talking to in Ukraine. The President Zelensky has made overtures along these lines, but his chief of staff, who's very powerful, is adamantly against any talk. So it depends on who you're talking to and on what day you're talking to, and the terms that were implied in some of these overtures are terms that are totally unacceptable to the Russians, meaning there'll be no talks. So it's one thing that it's like it's one thing to say, yeah, we're going to talk, we want peace talks, but you lay down terms that you know the Russians will never accept. So it's kind of just blowing in the wind, you know. I mean, it doesn't mean anything.
yes. Okay. Ultimately, does this have any direct impact on the U.S. economy as it stands currently?
It could if this is a signal for further escalation in the conflict. So that's the key. Escalation is always bad. Peace is always good. So if in terms of the economics of the situation, if things are calm and you got a peace, that's a positive. If things are escalating, that's a negative. So and if it's status quo, of course, it's just status quo. Nothing is changing. So where we are on that spectrum, we'll have to wait and see if there's an escalation. If there is, I would say it's going to be negative for the U.S. because it'll definitely be negative for Europe.
Let's take a look at this. This is Lockheed Martin shares, right? It's just been continuously going up since the end of July. So remember last week when we had this big market sell-off, not affected much. So
Right.
I don't know if the markets are pricing in some sort of escalation, possibly not even just with Ukraine, but it looks like defense stocks are doing well right now. Do you have any insight on this?
Oh yeah, defense stocks are doing very well. Defense stocks in the U.S. and in Germany, by the way, in particular.
Is that an indicator? Has that been a good indicator for heightened geopolitical tensions in the past, Professor?
I don't know.
I like to turn to the U.S. economy now. This was a question that was asked to me by one of my viewers, and what's his opinion on the article of Nero Rubini's on the effect of the Treasury on issuing more debt on the short side of the curve, and if it really counteracts the quantitative tightening of the Fed, and if that's the reason why we are not in a recession yet. So this is one of the articles that addressed this point. Let me just pull it up and read it to you. So this is from the New York Times. Uh, Look here. There's a story going around Wall Street that the Treasury Department is trying to help Democratic candidates in November by how it issues debt. I don't buy it, according to the author, Peter Coy. Nero Robini, a well-known economist who described himself as a lifelong Democrat, says that the Fed is in charge of managing the business cycle. The Treasury doesn't have that mandate. So here's the story. So apparently, what's going on is, let me just find this paragraph here. The Treasury is manipulating interest rates, the story goes, by selling relatively few long-term securities, such as 10-year Treasury notes and 20 and 30-year Treasury bonds. Investors competing for the limited supply of these long-term securities accept lower yields, so interest rates fall. The Treasury market is so big and important that when Treasury yields fall, other long-term interest rates also fall, such as rates on the 30-year mortgage. The claim is that the Treasury is overly tilting its debt issuance to bills, which matures in a year or less. That doesn't have much effect on shorter-term interest rates, which are more heavily influenced by the Fed's monetary policy. The story is that the Treasury, which is responsible for raising money by selling interest-bearing securities to investors, has kept a lid on long-term interest rates to stimulate economic growth in the stock market in an election year. So I'll let you comment on that. Is it true that the Treasury is trying to manipulate the election by manipulating interest rates?
Well, well let me first say that, that what you just read there, the hypothesis is that they're issuing short-term debt and staying away from long-term debt like the 10-year bond, and by doing that, the price of that this is a hypothesis now, but just so people get the mechanics of what we're talking about here before we start getting into the weeds on it. By doing that, if by not issuing by issuing fewer 10-year bonds than that would be, shall we say, normal, if that was the case, the price of the 10-year goes up and the yield goes down. And that's what's been happening, by the way. But in my view, it's not caused by this issuance from the Treasury. It's caused the 10-year yield. I've recommended, by the way, on the David Lynch show, many times I've recommended buying the 10-year. Remember, buying the 10-year, because the yield on the 10-year is going down, and now it's about 3.9%. I think when I started recommending on the David Lynch show, it was about 4.8%. So the yield has gone down from about 4.8 to 3.9. And when the yield goes down, the price goes up. So you get a huge capital gain. That's been a wonderful trade. Now, why did I think that was going to happen? I thought that was going to happen because we've had a contraction in the money supply. And when the money supply contracts, with a lag, inflation comes down. And bond yields follow inflation. That's what's going on. So if you look at the numbers on the 10-year and focus on it, think in terms of the following sequence: money supply down a year and a half, 2 years ago. Inflation, as a result, today going down. John Greenwood and I think it'll end the year at 2.5 to 3% on an annual basis. And now it's already down at 3%, but it's probably going lower. And next year it'll probably even go lower than 2.5%, given this unusual contraction we've had in the money supply. So that's what's behind driving the 10-year yields down, rather than this hypothesis and speculation that the Treasury is trying to manage the yield curve in some way. And so that's one point I'd like to make. The other point I'd like to make is that interest rates are not reflective of monetary policy. Changes in the money supply are reflective of the monetary policy. Monetary policy is not about changes in interest rates. Most people don't understand this. It's about changes in the money supply. And changes in the money supply eventually affect inflation, and that will affect the yield curve and interest rates. So that's my take on it. I think the article is a little bit of a tempest in a teacup kind of thing. What's really going on is the money supply. It's all about changes in the money supply. We have had a contraction in the money supply. The money supply, the stock of the money supply is lower now than it was in July of 2022. And that kind of contraction, we've only had 4 of those historically in the United States since 1913, when the Fed was established. And all 4 of those led to slowdowns in inflation and recessions. Actually, one of them, the one from 1929 to 1933, led to the Great Depression. So that's why I think this contraction will be like those contractions. Inflation will keep coming down, and later this year, we'll see continued slowdown in the economy and probably the start of a recession.
Okay, I want to come back to that, but just to finish off on what the Treasury's been doing. So this is the counter argument to the claim here, right? So first of all, Treasury Secretary Yellen denied this. We have never ever discussed anything of the sort, referencing manipulating the economy to rig the election. The critics' evidence is purely circumstantial, namely the Treasury issued a lot of bills recently. In fact, though, the Treasury has explained its modus operandi. It says it needed to issue a lot more debt than usual to restock the Treasury general account, which is the government's checking account. The government usually has more than $500 billion in the account, but it ran the account down to $23 billion in June of last year because of Congress's delay in raising the debt ceiling. Does this restocking of the Treasury general account have had anything to do with the decline in rates that we just discussed?
The contraction in the money supply is
Okay.
caused the inflation rate to go down, and the yields follow the inflation rate. That's what's going on.
So bottom line, it was the move down in the 10-year, which you've been correctly calling, is a reflection of market forces. It's not the Treasury manipulating.
Yeah, it's a reflection of. You see, here's the sequence, and people simply number one. Most people have no idea of what the quantity theory of money is, and that money is a fuel for the economy, and changes in the money supply with a lag, with a long and variable lag, affect inflation, and then that inflation, again with a lag, not a very long lag, is reflected in the yields on bonds. So the change in the money supply, then with a lag, you get a change in inflation. Then you get a change in yields on bonds because yields on bonds follow the inflation. If inflation is going down, let's make it even more simple. If the money supply contracts, goes down, eventually with a lag, inflation rates will come down. And if inflation rates come down, yields on bonds will come down. That's pretty simple. That's pretty straightforward.
Well, okay, so here's one more paragraph. The critics do have one valid point. The Treasury issues so much debt to keep the federal government operating that its decisions about issuance patterns really can have macroeconomic effects. It says here, with 27 trillion dollars marketable debt outstanding and rising, it takes less than a 4-point swing in the bill share to cause a market flow in excess of $1 trillion, which is in line with what the Federal Reserve could achieve with a moderately sized program of quantitative easing, also known as bond buying. So basically, debt issuance from the Treasury, is that in itself another form of quantitative easing, which may counteract quantitative tightening from the Federal Reserve?
No. We're talking about something completely different. The Treasury issuing debt to the general public, the non-bank public, does affect the economic activity in the following way. If they issue the debt to David Lynn, what do? You pay for it with a check, and that reduces your checking account, and that reduces the money supply. So in that sense, it does have an effect. It's not unrelated to economic activity, because economic activity is driven, given the quantity theory of money, by the money supply and changes in the money supply. So and in the hypothetical that I just gave you with you buying the debt, that reduces your checking account. You get a bond from the Treasury, okay? And in exchange for that, you write a check. And when you write that check, your checking deposit goes down and the money supply goes down. So if nothing else changes, that activity is something that slows the economy eventually down.
I mean, is it conceivable that Janet
Now
Yellen, who's
this
right?
second. Let me interrupt you. Now
Sure.
let's do the let's do the case where it wouldn't slow the economy down. They
Okay.
could issue debt, but what if they didn't sell the debt to David Lynn? What if they sold the debt to the Fed? What if the central bank bought the debt and the debt was monetized then? And the credit to the government account that you were just talking about, that would go up. The Fed would buy the Treasury bills. The 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 government account would go up, and the money supply would go up because the Fed would be issuing credit. Basically, they would be creating money to fill that government account to buy the bonds. So in that scenario, it depends on who's buying the bonds. People get all confused. They think if the government is running a deficit, that has to be inflationary, and it has to goose the economy. No, that's not correct. It depends on who they're selling the debt to. If they sold it to the non-bank public, to David Lynn and Steve Hanke, and the Fed did nothing, that would reduce our checking accounts because we had to pay for the bonds, and that would reduce the money supply, and that would slow the economy down. That would reduce the money supply. Alternatively, if the debt was sold to the Fed and it was monetized, that would increase the money supply and goose the economy. So you see what I mean? so so you got to run through what's going on everybody's balance sheet. It's a matter of looking at the balance sheets. You got to look at the balance sheet of the Fed. You've got to look at the balance sheet of the banks. You've got to look at the balance sheet of the non-bank public, and you've got to look at the balance sheet, obviously, of the Treasury.
Well, I'd like to ask you about the composition of the debt. I've been wondering this myself. So, first of all, it's been reported that the U.S. recently just surpassed $35 trillion of national debt. Now, as you can see here, federal government incurred expenditures of interest payments has exceeded $1 trillion in Q2 2024, according to the Federal Reserve data. I like to know who they're paying this interest to, because according to the federal government website, this is fiscaldata.treasury.gov, this is a breakdown of their debt. Debt held by the public is 27 trillion. Intra-governmental holdings, 7.1 trillion. So a big portion of, and the Federal Reserve, if I'm not mistaken, has they own some of this debt as well for open market committee actions. So I'm wondering if some of this interest payment that people are so concerned about is just them paying other government agencies. So it's not that big of a
Oh
deal.
yeah, whoever is holding the debt gets paid the interest. By the way, right now, T-bills, Warren Buffett's hoard of T-bills now is larger than the Fed's.
Yes.
So they're paying more interest to Buffett than they are the Fed.
Well,
You got the right charts up there. The debt's going up, and that bar chart, that colored bar chart you had up there,
yeah.
that thing, yeah, right. That gives a rough breakdown of who's holding the debt and who's receiving the interest payments.
So it's not.
And then I added a little color to the thing because Buffett liquidated in the first quarter of the year. Or maybe the second. I can't remember if it was first or second, but he liquidated about half of his Apple stock holdings, and of course by doing that he receives cash and he invested a lot of it in T-bills, and his stock of T-bills is now actually larger than the holdings of the Fed.
So there's been a lot of chatter that the U.S. can't afford to pay this $1 trillion of interest payments, but I'm looking at this and it just looks like they're paying themselves.
for the most part. Well, no, the non-bank public they're
Yeah.
paying other people most of it.
Well, is that an issue for you that they can't afford to pay? I'm going back to this $1.1 trillion dollars.
Well, okay, we have several issues here. Paying this interest now, tax that comes out of tax revenue. Taxpayers pay money in, and a big chunk of what they're paying in taxes is just to pay interest on the debt.
Yes.
That means interest is being paid for nothing. I mean, nothing is being received in any meaningful way by the interest that's being paid. The interest is just being paid to the people who have loaned money to the government in the first place. So their taxpayers are paying a lot of interest to receive nothing. Nothing. That's point number one. Point number two, the chart that you have up there right now, you can see that thing skyrocketing. And the Congressional Budget Office has indicated that the federal debt increases and levels are unsustainable. And if something can't go on, it will stop. So the question becomes, well, how could it stop? And there are only three ways that it can stop. One is that taxes could be increased. This would reduce the annual deficit. Two, that would be direct taxes. Two, indirect taxes. There could be an inflation tax, and if inflation kicked up, if they monetized more and more of the debt at the Fed, the money supply would go up, and just like it did after COVID hit, and we'd have inflation. There'd be an inflation tax. So direct taxes or inflation tax, that's two ways. And the third way is for the government to rein in spending, cut spending. Those are the only three possibilities. Now, those are three possibilities. The only way I think that we're going to solve this thing long term is to invoke Article 5 of the U.S. Constitution, have a constitutional convention, and at that convention, limit the discussion to discussions about controlling the debt and government spending, and put in something like the Swiss debt brake. The Swiss had a referendum in 2001, and the Swiss debt brake was passed, and the Swiss Constitution was changed. And now the Constitution mandates that the budget has to be balanced, and also Swiss government spending can't increase any more rapidly than the rate of growth in GDP or the rate of growth in the economy of Switzerland. So that's the only real solution to this, because there have been other attempts in the past to have statutory fixes. You know, remember Graham-Rudman? We had that worked. That was a statutory fix. It did rein in things and work for a while, and then was pushed to the sidelines and is basically inoperative. So all attempts to statutorily deal with this deficit and debt problem that is not sustainable have not worked in the past. I don't think they'll work in the future. I think the only way to fix it is to have a constitutional convention, change the U.S. Constitution, and put in a Swiss debt brake.
We have a few minutes left. I'd like to address a couple more viewer questions. This pertains to what you just said, Professor, from Tim Kent. Tim wanted to know, please ask Professor Hanke to comment on the astronomical fiscal deficit, which will lead to further increases in the money supply. So he's making the statement that the deficit that you just talked about will lead to a further increase in the money supply. Is that true?
No. The one we just went through how to handle the deficit and the debt that's unsustainable, but this increasing the money supply, we talked about that a little bit earlier. If you have a deficit and the Treasury is selling the debt to finance that deficit to the non-bank public, that actually reduces the checking accounts but held by the non-bank public and reduces the money supply, slows things down. The alternative, what we did with COVID, about 90% of the debt that was being issued was actually bought by the Fed. It was monetized. And the Fed, to buy that debt, created money to credit the government account and buy the bonds. So that increased the money supply. And of course, as a result, we ended up getting inflation. So the little trick in the question there, who was that? Tim asked that?
Tim, yes.
Yeah, Tim. So Tim's question, he assumed that the debt would all be bought by the Fed and be monetized, and the money supply would go up and inflation would go up. That is a possibility, but the other possibility is that the Fed buys nothing. They don't monetize anything, and everything's sold to the non-bank public. In that case, the money supply actually goes down and inflation would come down.
This leads to my final question. This is asked by a gentleman by the name of Andrea. Andrea asks, considering the high debt to GDP ratio in the U.S., currently at 129%, what could the U.S. government's response be in a recessionary environment if quantitative easing is not an option?
Well, I think the only real solution to this thing, long term, not in the short term, long term, will be to have a constitutional convention, focus on the solution to this unsustainable debt, and impose make a change in the U.S. Constitution that incorporates something like a Swiss debt brake, that would say something like government spending can't increase any more rapidly than anticipated growth rate in the U.S. economy, and the budget would have to be balanced.
Well, you've outlined what they should do. Let's assume they don't have as much common sense as you, Professor. What are they likely going to do instead?
One of the three options that I gave you.
Yeah.
Cut government spending, increase direct taxes, or increase the inflation tax.
Right.
That's the only possibility. Or just keep letting the thing grow on an unsustained basis. But again, if things can't go on, they will stop.
Yes.
And then you get into these three options. It's some mix of those things.
This has been great. Thank you, Professor Hanke, for coming on, and thank you to the viewers for submitting questions. If you'd like to submit more questions for next time, Professor Hanke will be on, every 2 weeks or so. Please submit questions to his email down below. How can we reach you?
I think the easiest way is to just follow me on Twitter. It's @Steve_Hanke. Or if you want to be added to my distribution list to receive articles that I'm writing and things like that, send me an email, Hanke, Hanke, @jhu.edu.
All right. Please sign up to Professor Hanke's distribution list, and we'll speak again next time, Professor. Thank you very much.
Okay. Thank you, David. Have a good afternoon.
You as well. Thank you for watching. Don't forget to like and subscribe.